Hey everyone, welcome back to Corporate Decoder. Today, Fidelity Advisor Series VIII just filed their semi-annual shareholder report as of the 30th of April 2026, and I am seeing a very consistent story across multiple funds here. Quick note, this is not financial advice, just my take on public filings for educational purposes. The main takeaway is that while the overall fund sizes are substantial, the underlying strategy and asset allocation paint a clear picture of what Fidelity is focused on right now. This is a certified shareholder report, a pretty standard document for registered management investment companies like Fidelity Advisor Series VIII. It's giving us a look under the hood of several of their funds, specifically looking at their holdings and financial performance for the 6 month ending the 30th of April 2026. Let's dive into what the report tells us about their investment strategy and how these funds are structured. We are looking at several different classes within the Fidelity Advisor International Capital Appreciation Fund, which gives us a good overview of how different share classes are performing and what they are invested in. First off, let's talk about costs for a hypothetical $10,000 investment in the Class Z shares of the International Capital Appreciation Fund. The cost for those 6 months were only $31, which is a very low 0.62% of the investment. That's quite a deal. On the other hand, Class C shares were a bit pricier at $88, about 1.73% of the investment. This difference in cost between share classes is pretty typical and reflects different fee structures, especially around sales charges. Now, for the big numbers, the total fund size for the International Capital Appreciation Fund as of the 30th of April 2026 was a massive $16,250,767,968. That is over $16 billion. That clearly shows the scale of these operations and the trust investors place in them. What did this huge amount of money actually invest in? When we look at the market sectors, the biggest chunk, about 33.2%, went into industrials. Information technology was the next biggest at 27.0%, followed closely by financials at 24.2%. This tells us Fidelity is heavily betting on these core sectors for growth. They are also holding about 6.7% in materials and smaller amounts in consumer staples, consumer discretionary, utilities, and communication services. The common stocks alone make up 100.1% of the fund's net assets, with a tiny negative percentage coming from short-term investments and net other assets, which is pretty much a full investment in stocks. This 100.1% in common stocks confirms that the fund is almost entirely invested in equities. This is a strategy focused on growth and potentially higher returns, but also comes with higher risk compared to funds that hold more bonds or cash. Where are these investments geographically? The United States holds the largest portion at 19.8%, but it is not an overwhelming majority. Japan is a significant player at 15.8%, followed by Taiwan at 6.9%, the United Kingdom at 6.8%, and Israel at 6.5%. They also have substantial investments in the Netherlands and Germany, both at 5.2%, and India and Spain at 3.8% each. The remaining 26.2% is spread across others, which means they are diversified globally, but with a clear emphasis on developed markets like the US and Japan, and key tech hubs like Taiwan and Israel. Let's see some of the specific companies they are invested in. The biggest holding by far is Taiwan Semiconductor Manufacturing Co. Ltd. at 6.9% of the fund's assets. Then we see ASML holding NV at 3.1%, SK Hynix Inc. at 2.5%, and ASM International NV at 2.1%. These tech companies, especially in semiconductors, are clearly core to their strategy. We also see names like Schneider Electric CAs, Hitachi Ltd, and Siemens Energy AG, which are industrials, and Rolls-Royce Holdings plc, another industrial company. The fact that a significant portion of the top holdings are in tech and industrials really reinforces the sector breakdown we saw earlier. Standard legal disclaimers and copyright information from Fidelity. We are seeing a similar pattern across other funds as well, like the Fidelity Advisor Global Capital Appreciation Fund. This fund also reports its semi-annual shareholder information as of the 30th of April 2026. For this Global Capital Appreciation Fund, the costs for Class M shares over 6 months were $79, or 1.55% of a hypothetical $10,000 investment. This is higher than the Class Z shares of the International Fund, which again highlights how share class expenses can vary significantly. The fund size here is much smaller, at $176,426,894. While still a large sum, it is considerably less than the $16 billion we saw earlier. This difference in fund size can impact investment strategies and flexibility. The sector allocation here is interesting. Information technology is the dominant sector at 36.3%, followed by industrials at 16.6% and financials at 15.1%. Communication services is also a notable portion at 8.8%. This fund seems to have a stronger tilt towards tech compared to the International Capital Appreciation Fund. Again, a very high allocation to common stocks at 95.8%. Preferred stocks make up a small 0.4%, and the rest is in short-term investments and net other assets. Geographically, this fund is heavily weighted towards the United States at 67.5%. That is a much higher concentration than the International Fund. Taiwan, Korea, and Japan are next, each around 4.4% to 4.7%, followed by China at 3.5%. Looking at the top holdings for the Global Capital Appreciation Fund, we see some familiar tech giants, Nvidia Corp at 7.2%, Alphabet Inc. Class A at 5.1%, Taiwan Semiconductor Manufacturing Co. Ltd. ADR at 4.7%, and SK Hynix Inc. at 4.4%. Amazon.com Inc. is also in there. This fund is clearly riding the wave of big tech. Switching gears to item 7, the financial statements and highlights for the International Capital Appreciation Fund. This section really gets into the nitty-gritty of the fund's performance and holdings. The schedule of investments is where we see the actual breakdown of where the money is. For common stocks, as of the 30th of April 2026, they list out each country and then drill down into sectors and specific companies. They have Erste Group Bank AG in Austria, representing 1.3% of net assets. In Brazil, Wheaton Precious Metals Corp is listed, making up 1.5%. For Canada, Celestica Inc. United States is a holding, and Franco-Nevada Corp. China contributes 1.4%, with Contemporary Amperex Technology Co. Ltd. as shares. Germany is represented by Siemens Energy AG and Heidelberg Materials AG. India shows up with Bharti Airtel Ltd., ICC Bank Ltd, and Adani Ports and Special Economic Zone Limited. Israel has a substantial 6.5% allocation, with holdings in Next Vision Stabilized Systems Ltd and various banks like Bank Apollo and BM. Japan is a major destination for investments with holdings across financials, industrials, and information technology. This confirms the earlier breakdown of their geographic focus. The total cost for all these common stocks was over $12.2 billion, and their value at the end of the period was over $16.2 billion. That is a significant gain on paper for these investments. Looking at the statement of assets and liabilities, the net assets for the fund were a colossal $16,250,767,968. That is the total value of the fund after subtracting liabilities. When we look at the per share data for Class I shares, the net asset value was $37.67. That is the price of one share of the fund. The statement of operations for the 6 months ending the 30th of April 2026 shows how the fund made and spent money. Investment income was over $118 million. Expenses were around $57.8 million, resulting in net investment income of about $60.5 million. The fund also saw substantial gains. Net realized gain on investment securities was over $491 million. The change in net unrealized appreciation, meaning the increase in value of investments that they still hold, contributed another $175 million. The statement of changes in net assets shows the overall movement. For the 6 months, the fund saw a net increase of over $729 million from operations alone, but distributions to shareholders reduced that slightly. However, share transactions, meaning people buying and selling shares, added over $334 million to the net assets. Looking at the financial highlights for Class of shares, the net asset value per S-Share at the beginning of the period was $35.17 and ended at $34.77. This means a slight decrease in net asset value per S-Share during this 6-month period. The total return for Class of shares was 4.56% for this 6-month period. That is a positive return even with the slight dip in net asset value per S-Share. It shows the distributions helped offset that. The ratios to average net assets provide a clearer picture of expenses. For Class A, the expenses before reductions were 0.98% of average net assets. This is a crucial metric for investors to understand how much of their return is going towards fund operation. For Class M shares, the net asset value also saw a slight decrease, starting at $33.97 and ending at $33.56. The total return for Class M was 4.44%. Also positive but slightly lower than Class A. Their expenses before reductions were 1.23%, which is higher than Class A. This difference in expense ratios between share classes is something investors should always pay attention to. Class C shares experienced a larger drop in net asset value from $29.68 to $29.08. Their total return was 4.19%, which is still positive but lower than Class A and M, coupled with higher expenses of 1.73%. This shows why choosing the right share class is important. Now, looking at the Fidelity brand fund itself, not the advisor class specifically, the net asset value, per share started at $37.97 and finished at $37.49. The total return was 4.70%. This fund seems to have slightly better performance and lower expenses at 0.69% compared to the advisor classes. Class I shares, which typically have lower expenses, started at $37.96 and ended at $37.67, with a total return of 4.69%. And finally, Class C shares, which usually have the lowest expenses, started at $38.09 and ended at $37.78, with a total return of 4.77%. The very small difference in total return between these classes, despite expense differences, highlights that other factors like investment performance are also playing a big role. Moving into the notes to financial statements, we get into the details of how these funds are organized and managed. The Fidelity Advisor International Capital Appreciation Fund is part of the Fidelity Advisor Series VIII Trust, and it is structured as a Massachusetts business trust. It offers multiple share classes, each with its own fee structure. The report notes that investments in emerging markets can be very volatile, which is a standard risk disclosure. Fidelity funds can invest in these things called Fidelity Central Funds. These are like internal mutual funds that primarily serve other Fidelity investment companies. The report says the investing fund indirectly pays the expenses of these central funds, which is pretty standard practice in the industry. This section explains how they value the investments. They use quoted prices from markets when available, which is level 1. If those aren't available, they use other observable inputs like interest rates, which is level 2. And if there are really no observable inputs, they use their own assumptions, which is level 3. The key thing here is that for most of their common stocks, they are using level 1 or level 2 pricing, meaning they have pretty good visibility into the market value. No significant level 3 investments seem to be highlighted in this fund's breakdown. If the fund invests in foreign countries, it has to deal with currency fluctuations. And this section explains how they handle that by translating values into US dollars. This explains how income, gains, losses, and common expenses are split up among the different share classes. It acknowledges that the per share expense ratios can vary because of these different class level services and fees. The purchases and sales of investments show a massive amount of activity for the International Capital Appreciation Fund, with over $10.7 billion in purchases and over $11 billion in sales during this 6-month period. This high turnover suggests active management. This is a crucial section detailing the fees paid to Fidelity Management and Research Company LLC, the investment advisor. The tables show the maximum management fee rates for each class, and importantly, the total annualized management fee rates. For Class A shares, it is 0.78%. For Class M, it is also 0.78%. Class C is 0.78%. International Capital Appreciation Class is 0.73%. Class I is 0.78%, and Class Z comes in lowest at 0.66%. These are the actual fees being paid, not just the maximum potential fees. The report also details the performance adjustment, which can add or subtract from the basic fee based on how the fund performs against an index. For this period, the performance adjustment was negative 0.07%, meaning they actually got a slight discount on management fees because their performance was slightly behind the benchmark index. Then we have the 12B-1 fees for distribution and service plans, which are additional fees paid to Fidelity Distributors Company LLC or FDC. These fees are different for each class, with Class C having the highest distribution fee at 0.75%. The total fees charged here were over $2 million. The sales load section talks about upfront sales charges for Class A and Class M shares, and contingent deferred sales charges for redemptions. Even though these are paid to FDC, they represent costs borne by the investor. This disclosure shows that a small amount of brokerage commissions were paid to affiliated firms, which is normal in the industry. Fidelity also has an interfund lending program which allows funds to borrow from or lend to each other at beneficial rates. For this fund, they actually acted as a borrower in this program, taking out an average loan balance of over $83 million at an interest rate of 3.92%. This is a way they manage short-term liquidity needs. This is an interesting part. Funds can lend out their securities to earn extra income. The report details the fees paid to the lending agent National Financial Services, an affiliate of Fidelity. For this fund, they paid about $44,000 in fees. They also mention non-cash collateral held, which is a bit complex. But essentially, it is a form of guarantee against the loaned securities. This section explains how certain uninvested cash balances and custodian credits are used to reduce the fund's expenses. It is a small but positive way they try to cut down on costs. The distributions to shareholders show a large amount of money being paid out to investors, over $849 million for the 6-month period. This signifies that the fund is returning profits and capital gains to its investors. Share transactions show a lot of activity. For class of shares alone, they sold over 3.2 million shares and redeemed over 2.2 million shares, resulting in a net increase in shares. The dollar amounts reflect this large inflow and outflow of investor money. Standard disclosure about indemnification for trustees and officers, a common practice in fund structures. This is the usual risk disclosure, warning that global economic disruptions, conflicts, and other events can impact investment performance. It emphasizes that concentrations in certain security types or locations can magnify these risks. This is a significant piece. On the 25th of July 2025, the Fidelity Advisor International Capital Appreciation Fund acquired all the assets and liabilities of the Fidelity International Capital Appreciation Fund. This means the fund essentially merged with another one, gaining access to a larger portfolio with similar goals. The report clarifies this was a tax-free reorganization, skipping over the boilerplate items like disagreements with accountants and proxy disclosures as they have see item 7, or are marked as not applicable. This information is part of the financial statements, so we've already touched on its implications through expense ratios. Another section marked as not applicable. And finally, the signatures from the President and Treasurer and Chief Financial Officer confirming the accuracy of the report. These are the people ultimately responsible for the accuracy of these filings. Overall, this filing for Fidelity Advisor Series VIII gives us a clear look at their investment strategy. Particularly for the International Capital Appreciation Fund, they are heavily invested in global equities with a significant focus on tech and industrials. While the fund is massive, the share class differences in costs are notable. The performance is positive, but the expense ratios, especially for certain classes, are worth considering for any potential investor. The mention of a reorganization also suggests ongoing consolidation and strategic adjustments within Fidelity's fund offerings. The risk disclosures are standard, but the scale of investment and high turnover rate do point towards an active growth-oriented strategy which comes with its own set of market risks. Oh, and the research tools I actually use are linked in the description. They help keep this channel going. That is my take. Stay decoded. If you found this analysis helpful, please like and subscribe. You can also join our Discord community linked in the description.